Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. For a long time now, if you've been following the world of crypto and corporate adoption, there's really been one name that's just dominated the conversation: MicroStrategy, or MSTR.
Absolutely, head and shoulders above everyone else.
Right. And their leader, Michael Saylor, he didn't just dip a toe in. He went all in, adopting what everyone now calls the diamond hands strategy.
You really did. They basically turned their traditional software business into the world's biggest publicly traded holder of Bitcoin.
They were the champions. For so many investors, especially the big institutions, MSTR was it. It was the only real legitimate way to get heavy exposure to crypto inside a normal brokerage account.
And that history is so important to understand because it sets the stage for the incredible risk they're facing right now. The whole story around MSTR has always been this aggressive, super optimistic bet. But what we're seeing in the data now is that while Bitcoin itself is, doing pretty well, MSTR's specific decisions are creating these compounding problems. The evidence suggests they're shifting from being that crypto champion into something much more dangerous for investors.
Something you've called a potential market time bomb.
That's what the analysis points to, yes.
Time bomb is a strong phrase. It definitely gets your attention. When we're talking about a company this big, so tied to Bitcoin's price, what are the specific pieces that are turning this strategy into such a risk?
We've really drilled down into the data, and there are three specific converging risks that we need to unpack in this deep dive.
Yeah.
First, there's the immediate pressure point, a psychological tripwire tied to a very specific Bitcoin price that could just ignite panic selling.
Okay, a trigger. What's second?
Second is the smart money, the calculated, really aggressive attack from short sellers who are targeting MSTR's unique weaknesses, not just Bitcoin's volatility.
And the third?
And third, this is the big one, the major structural threat, the almost certain exclusion from a critical global investment index, which would trigger a massive forced sale of their stock.
Wow, okay.
So our mission today is to take these, complicated financial ideas, break them down with simple analogies, and give you some clear, actionable strategies. We really want you to understand why MSTR is no longer that simple, safe way to get Bitcoin exposure.
All right, let's start with that immediate pressure point, the line in the sand you mentioned. Looking at the market right now, late November 2025, Bitcoin has been, choppy.
Choppy is a good word for it.
It's hovering around, what, $78,000?
Mm-hmm.
And it seems to be struggling to get that momentum back that it had earlier in the year.
And that struggle is really key here. The whole political and economic environment is, let's just say it's sensitive.
We saw that just last week.
We did. I mean, look at the recent turbulence. You had President Trump make some, off-the-cuff comments about potential new tariffs, and that was enough to push Bitcoin down below that $80,000 mark, even if just for a bit.
And when an asset reacts that quickly to news that has nothing to do with its fundamentals, it really shows you how volatile it is.
It absolutely does. And that volatility hits MSTR exponentially because of all the debt they're carrying.
Okay, so that highlights the instability. But you mentioned a specific number that's way more important to MSTR than $80,000. That number is $75,000. Why that figure? Why is $75,000 the number that would give the finance team at MicroStrategy nightmares?
That $75,000 number is the whole foundation. It represents MSTR's average Bitcoin purchase price.
So that's what they paid, on average, for every single coin they own.
Exactly. This isn't just some random number. It's the weighted average cost of all their Bitcoin since this whole strategy started. It factors in all the debt they took on, all the big market purchases they made over the years.
Can you break that down a bit? Because I think a lot of people remember Bitcoin being much, much lower. How did their average get so high?
It's a great question. They didn't just buy it all at once. At first, they were using cash they had on hand, but their biggest buying sprees were funded by issuing convertible notes.
Which is just a form of debt.
It's debt, exactly. And they were buying aggressively even when the price was already high because they were using that debt money and wanted to get into the market fast. To use an analogy, think about building a huge custom house.
Right.
Maybe you bought the land for cheap years ago, which is great. But then you paid peak price for all the lumber, and you hired the most expensive contractors during a building boom. Your average cost for the whole house isn't just that cheap land price. It gets pulled way up by all the expensive materials you bought later.
Right, I get it. So for MSTR, that average weighed down by all the debt and the purchases they made when the market was hot, is sitting right at $75,000.
Firmly at $75,000.
So as long as Bitcoin stays above that, even at $75,001, they're in a position of, what do you call it, paper profit.
That's their safety net, structurally speaking. If Bitcoin's at $78,000, they can go to their investors and say, see, our big bet is winning.
But the moment it dips below $75,000,
The moment it dips, even for a day, they flip into a position of paper loss, a loss on the books. And that's where the risk stops being about accounting and starts being about psychology.
the psychological fallout. Let's talk about the regular investor, the person who bought MSTR
Right.
because they bought into the story of Michael Saylor being a genius.
That story is everything. MSTR was sold to the public as this, maximalist, aggressive, and ultimately unbeatable strategy. The second the company has to admit in a public filing that they are officially underwater on their main asset,
That the big bet isn't winning anymore.
that's when confidence just shatters. It becomes a trigger for that immediate, almost irrational fear we call panic selling.
But hold on, Bitcoin is famously volatile. It goes down, it comes back up.
Yeah.
Why would investors panic over what could just be a temporary paper loss?
Because of how trust works, especially with a story this big and leveraged. Think of it like this. Imagine everyone believes a particular dam is absolutely indestructible.
Okay.
And then one day, you see a small crack form in the concrete. The dam might not break that day, or even that week. But the moment the public sees that physical proof of a weakness, their idea of the risk changes completely. It goes from 0 to 100.
The perception of safety is gone.
It's gone. And the investors who bought MSTR because they believed it was infallible, they won't stick around to see if the crack gets fixed. They'll run because they'll be terrified that the smart money leader, Saylor, got it catastrophically wrong. That $75,000 line isn't just about math. It's the psychological trigger that could start a huge cascade of selling.
Well, let me just push back on that a little. The price is currently $78,000. That's a few $1,000s of buffer. What if Bitcoin rallies hard? Say it shoots up to $100,000 before any major downturn. Doesn't that make this whole $75,000 risk kind of irrelevant?
That's a fair question, and it's absolutely what the bulls who support MSTR are hoping for. A big rally would definitely increase that buffer. It would push that paper loss line further away.
Right.
But the analysis shows two things. First, as we've seen, market volatility, especially with all the political noise, can wipe thousands off the price in just a couple of days. A $3,000 buffer can vanish very quickly.
And what's the second thing?
The second is MSTR's leverage. Their stock price tends to overshoot Bitcoin's moves. So a 5% drop in Bitcoin might translate to a 10% or even 15% drop in MSTR stock. Even a really quick flash crash below 75K that recovers in a few hours could be enough to start that panic selling we talked about. So yeah, a rally helps, but it doesn't remove the sensitivity to that line.
And that sensitivity is exactly what the short sellers are looking at.
That is precisely the weakness that the smart, sophisticated money is now actively trying to exploit.
Okay, so before we dive into the specifics of this short selling attack, let's just make sure everyone is crystal clear on how short selling actually works. It's a bit counterintuitive for a lot of people.
Absolutely. Most of us get buying a stock, going long, you hope it goes up. Shorting is the exact opposite, and it can be way riskier.
Infinitely riskier, technically. A short sale is just a bet that a stock's price is going to fall. The process is pretty straightforward. First, you borrow shares of the stock from a broker.
Okay, so you don't even own them yet.
You don't. Then you immediately sell those borrowed shares on the open market at whatever the current high price is. Then you wait.
You wait for the price to drop.
You wait for it to drop. Then you buy back the same number of shares at that new lower price, and you return them to the broker you borrowed them from. The difference in price is your profit.
But the risk is that if the stock goes up instead, you still have to buy those shares back to return them, and you could lose a ton of money. A ton. Your losses are potentially unlimited. So short sellers are often seen as the cynics of the market, right? They're looking for flaws. But the data on MSTR suggests this has gone way beyond simple skepticism.
It's evolved from a defensive move to a full-on targeted attack.
That's the shift we're seeing. For a while, shorting MSTR was what we'd call a simple market hedge. A big fund might be long Bitcoin betting it'll go up, but they'd short a little MSTR on the side.
Like an insurance policy.
Exactly. It was just insurance. If the whole crypto market crashed, the money they made on their MSTR short would help offset the money they lost on Bitcoin. It was a broad strategy.
But that's not what's happening now. The data shows these funds are no longer using it as general insurance. They're specifically targeting MSTR's own problems, regardless of what they think Bitcoin will do.
That is the critical change. The data shows that MSTR's short interest ratio, that's the percentage of all their shares that have been borrowed for shorting, has shot up to an all-time high.
And that's not cautious behavior.
Not at all. This signals extreme pessimism and, more importantly, high conviction among these very sophisticated investors. They aren't just betting Bitcoin will fall, they are betting that MSTR will fall relative to Bitcoin because of its own specific flaws.
Okay, so that raises the big question. Shorting is so risky. Why are these professional funds so confident? Why are they willing to put so much money on the line to short MSTR right now, especially when the general feeling about Bitcoin is still pretty positive?
They're confident because they see two major non-Bitcoin related flaws that they believe practically guarantee MSTR stock is going to underperform. The first one is NAV overvaluation.
NAV, net asset value.
Right. It's the real tangible worth of the company. For MSTR, you can calculate it pretty simply. It's the total market value of all the Bitcoin they own minus all the debt they have on their books.
And in a perfect world, MSTR's stock price should be pretty close to that NAV number.
It should track it closely, yeah. Maybe you pay a tiny bit more or premium for the management, or maybe it trades a little lower or a discount because of the debt. But for years, MSTR traded at a huge premium to its NAV.
People were paying more for the stock than the Bitcoin it held was actually worth.
A lot more. At times, it was trading at 1.2 or 1.3 times the value of its Bitcoin. And investors were willing to pay that extra fee because, like we said, MSTR was the easiest way to get BTC exposure in a regular account. That premium was the price you paid for access.
So if I bought MSTR back then, I was basically paying $1.30 for a dollar's worth of Bitcoin, but I was okay with it because of the convenience in the sailor story.
You've got it. But the short sellers are now betting that premium is about to just evaporate. They look at the market and see all these new Bitcoin spot ETFs.
The convenience factor is gone.
It's totally gone. They're asking, now that anyone can buy a dollar's worth of Bitcoin for, a dollar and a tiny fee through an ETF, why on earth would they keep paying a 30% premium to own MSTR, which also comes with a mountain of debt and management risk?
It's a bet that the stock price is going to fall back to reality to meet the actual value of what it owns.
A painful reversion to the mean. That's the bet.
That makes a lot of sense.
Yeah.
What's the second reason they're targeting MSTR, the one you said might be even more dangerous?
The second reason is that the short sellers are getting ahead of the game. They are front-running the huge structural crisis we're about to talk about, that index exclusion risk.
So they see what's coming in January.
They see it with almost perfect clarity. These funds see the near certainty of MSTR getting kicked out of a major index, which will force billions of dollars of selling. So they are positioning themselves right now to profit from that guaranteed wave of selling. It's not a guess, it's a bet on a scheduled event.
Wow. So this is almost a perfect storm. The shorts are pushing the price down, which increases the fear, which gets it closer to that $75,000 psychological breaking point, all while they're getting ready for the big guaranteed shock in the new year.
You've connected the dots perfectly. That all-time high short interest isn't just a number. It's a collective forecast from the professional market saying that MSTR is structurally broken and fundamentally mispriced, and that has nothing to do with whether Bitcoin goes to the moon or not.
Cool. Okay, so we've covered the psychological weak spot and the sharks circling in the water, the short sellers. Now we need to talk about the iceberg, the core non-negotiable structural threat, MSTR's membership in the MSCI index.
Right. And this is something that, unlike the Bitcoin price, MSTR has almost no control over.
None whatsoever. They can't just buy their way out of this problem or hope for a market rally to fix it. This is about rules.
So let's start with the basics, because index membership can sound a little dry, but the impact here is anything but. What is MSCI, and why should anyone care what they think?
MSCI stands for Morgan Stanley Capital International. They're one of the biggest and most important global index providers in the world. You can think of them as like the people who create the VIP lists for global investing.
The gatekeepers. They're the gatekeepers. When a company gets included on an MSCI index, it's a signal that it meets all these strict rules for size, for how easily it trades, and for what kind of business it is.
And what happens when a company makes it onto that VIP list?
Billions of dollars in guaranteed investment just flows in automatically. Huge global funds. We're talking giant pension funds, sovereign wealth funds. They are mandated to track these indexes perfectly. So if MSCI says buy this stock, these funds have to buy it. It's the ultimate seal of approval.
Inclusion is a huge tailwind. But the analysis we're looking at says MSTR's exclusion isn't just a risk, it's a near certainty. Why are experts so sure about this?
It comes down to MSTR's entire business pivot. See, MSCI classifies every company using a global standard. When MSTR started, they were very clearly a software company. That was their classification.
But they're not really a software company anymore, are they?
Not really. The data confirms that Bitcoin now makes up close to 80% of their total assets. And that massive shift fundamentally breaks the rules for their current classification.
So they've physically changed what their company is, but the index still has them listed under the old label.
You've nailed it. If 80% of your assets are a single digital currency, you can't reasonably be called a standard software company anymore. So MSCI is almost certain to reclassify them. They'll essentially get a new label, something like a digital asset holding company.
And that new label is the problem.
That's the whole problem. Because under the rules of the main MSCI indexes, these super specialized, highly concentrated companies often don't qualify for inclusion. They just don't fit the mold.
Okay, that makes sense. Let's think about this like a regulatory issue. Have we
Yeah.
seen this happen before? A company changes so much that it gets reclassified and kicked out of an index.
Oh, absolutely. It happens, though, maybe not at this scale with crypto. You might see, say, a manufacturing company that slowly sells off its factories and starts buying up real estate.
Yeah.
At some point, the index provider steps in and says, hey, you're not a manufacturer anymore. You're a real estate company.
And what happens then?
The stock gets moved. And any fund that specifically tracks the manufacturing index is legally forced to sell all of their shares immediately. The result is always huge volatility and usually a big sustained price drop. MSTR is facing that exact problem, but just amplified because of how concentrated they are.
So the reclassification seems unavoidable. When is the deadline for this? When does this time bomb go off?
The date everyone is circling on their calendar, according to the analysis, is January 15th of next year. That's when the index rebalancing decision is expected to be finalized and announced.
And that leads us to the damage. If this happens, how much money are we talking about? How big is the exodus from MSTR stock?
The number is staggering. It's estimated to be approximately $9 billion in forced capital flight.
$9 billion. With a B.
With a B. To put that in perspective, that's around 40% of MSTR's entire market capitalization that will be forced to sell. Not choosing to sell, forced to sell.
Let's really hammer that point home. What is a passive fund exodus? Why is this different from just a normal bad day on the stock market?
This is the absolute key. Passive funds, like all those big, low-cost ETFs and index funds, don't have a manager sitting there picking stocks. They're just computer programs and mandates designed to perfectly copy an index.
They have no choice.
Zero choice. When MSCI announces MSTR is out of the index, the charter for these funds mandates that they sell every single share of MSTR they own by a certain date. They can't decide to hold on because they think Bitcoin is going up. They are forced sellers.
However, I'm managing one of these passive funds, and I have $1 billion of MSTR stock and the index kicks it out. I have to dump it all, no questions asked, even if I personally think it's a great company.
Absolutely. A forced seller doesn't care about getting the best price. They only care about getting the trade done before the deadline. So you're going to have this guaranteed, massive, concentrated outflow of $9 billion hitting the market all at once. The market just can't absorb that kind of shockwave without a severe, dramatic price drop.
It's a looming threat. But let me just play devil's advocate one more time. Could MSTR do something? Could they negotiate with MSCI? Is there any way for a company to convince an index provider to, make an exception?
It's a logical question, but the world of index governance is very rigid. It has to be. Trillions of dollars depend on these rules being applied fairly and predictably to everyone. MSCI's main job is to make sure their indexes are accurate. If they made a special exception for MSTR, it would undermine the credibility of their entire system.
The rules are the rules.
The rules are cold, hard, and apply to everyone. Given how far MSTR has deviated from the standard, the analysis is clear. An exception is extremely unlikely.
So let's trace this to its worst-case scenario. What happens when this forced selling causes that huge price drop? How does that connect back to MSTR's actual business?
This is where it gets really dangerous. That severe stock price drop from the $9 billion exodus could immediately create immense liquidity pressure because of MSTR's debt.
Real leverage.
Their leverage. They raise a lot of this money through convertible notes and other loans, and those loans have rules or covenants. When the value of the company, the stock price, plummets by 40% or more, they can violate those covenants. That could lead to margin calls or demands for early repayment from their lenders.
And suddenly, MSTR needs to find a lot of cash very, very quickly.
An enormous amount of cash. And the only place they have that kind of money is their Bitcoin stack.
So they would be forced to sell Bitcoin.
This is the ultimate existential threat. They would be forced to sell their core asset to cover their debts. And that action, triggered by a simple index rule, would completely shatter the Diamond Hands promise that their entire company is built on. It would be a catastrophic loss of investor trust.
So the MSCI exclusion isn't just some stock market technicality. It's the trigger that could force MSTR to destroy its own core identity.
And, when we think about whether MSTR would actually be forced to sell its Bitcoin, we don't have to just guess. There's a history here. We can look at other companies that tried to do something similar. These digital asset treasuries or DA companies.
MSTR was the biggest, but they weren't the only ones to mix a regular business with huge crypto holdings. So what does the history show? What happened to those other companies when they came under pressure?
The pattern is it's chillingly consistent. When these other diet companies saw their stock prices tanking, they almost always tried to use their crypto to stop the bleeding.
They started selling.
They started selling bits of their crypto to raise cash, trying to prop up their stock price or pay down debt or just calm everyone down.
Which sounds like it makes financial sense in the short term, but it must be a disaster for their credibility.
A total disaster. Because every time they sold, even if it was the right move for the company's survival that day, it broke the fundamental promise they made to their investors. People bought those stocks because they believed in the HODL forever idea.
And when the company doesn't HODL?
Trust just evaporates. And what we saw time and again is that this act of selling actually made the stock crash even faster. It created this death spiral. Selling crypto makes the stock fall, which creates more financial pressure, which forces them to sell more crypto, and on and on.
Which brings us right back to Michael Saylor. His entire brand, the whole MSTR story, is built on that one unwavering promise. We will absolutely never sell.
That promise is the bedrock. It's what MSTR's premium valuation was built on. Saylor's personal conviction is, it's legendary. But the question the entire market is asking right now, especially with this $9 billion threat on the horizon, is this. Can a philosophical promise survive the cold, hard reality of a financial crisis?
In other words, when the bank calls because of an MSCI rule, does your ideology matter more than staying solvent?
The market seems to be betting that solvency wins. Every time. MSTR's leverage is so extreme that if this MSCI decision forces 40% of their value out the door, the financial chaos that follows will almost certainly override any philosophical stance. They wouldn't be selling because they lost faith in Bitcoin. They'd be selling because their debt agreements demand it.
And what's so interesting here is that the damage isn't just the sale itself. The analysis suggests the real catastrophe is the broken promise.
That's it. The analysts all agree that the collapse of investor trust, the day it's confirmed MSTR sold even one for rider, Satoshi will probably hurt the stock price more than the initial drop from the index exclusion. The story will be shattered. MSTR would no longer be the Diamond Hands champion. They'd just be another over-leveraged company fighting for survival.
So this is a massive credibility test. The market is basically weighing their financial structure against their philosophical promise, and January 15th is when the results come in.
And the closer we get, the more that doubt is going to create volatility. Investors have to realize this isn't a bet on Bitcoin anymore. It's a high-stakes bet on MSTR's ability to navigate a very complex, very dangerous institutional minefield.
Okay, let's pivot to the most important part of this whole deep dive. What do you do with this information? The actionable strategy. And it feels like the first most essential step is a mental one, a paradigm shift. MSTR is no longer a proxy for Bitcoin.
It cannot be said enough. We have to go back to why MSTR got so popular. A few years ago, if you were a big fund or just a regular person with a 401k, MSTR was really the only publicly traded, regulated way to get meaningful Bitcoin exposure. It was the only game in town.
It was the gateway drug, so to speak.
It was the gateway. But the world has totally changed. With the approval and wild success of the new Bitcoin spot ETFs, IBIT, FBTC, all of them, that unique advantage MSTR had is just gone.
It's obsolete.
Completely. The market now has these direct, cheap, and liquid ways to own actual Bitcoin.
Let's go back to that analogy we were using. MSTR was like the only factory in the world that made a specific flavor of ice cream. If you wanted that flavor, you had to buy the whole complicated, debt-ridden factory.
That is a perfect way to put it. But now the grocery store sells that exact flavor right on the shelf. These ETFs are the ice cream itself, pure Bitcoin exposure for a fraction of the cost, and without any of the factory's debt or management drama or, structural problems.
MSTR's whole reason for being as an investment has kind of vanished.
Yeah.
So if it's not a Bitcoin proxy anymore, what is it? What should we call it?
The data suggests the best way to classify MSTR now is as a hyper-risky derivative. It's a perfect description because of all the layers of risk. When you buy MSTR stock, you're not just buying Bitcoin. You're buying Bitcoin with 4 extra layers of risk stacked on top.
Okay, let's break those down. Layer 1 is just the normal risk of Bitcoin itself. It's volatility.
Right, the baseline risk. But then comes layer 2, management risk. You're betting on Michael Saylor's decisions. You don't have that risk with a simple ETF.
Then layer 3 is the big one we've been talking about, the debt and leverage risk, the risk that they could get a margin call and be forced to sell.
The catastrophic risk. And finally, layer 4, the immediate crisis, the MSCI index exclusion risk, the risk of that $9 billion forced sale.
So you stack all 4 of those risks together.
Exactly. And you ask yourself, when you can buy an ETF that only has layer 1 risk, why would you voluntarily take on all 4? For most people who just want exposure to the price of Bitcoin, it's become financially irrational to hold MSTR. The spot ETF is just the safer, smarter choice.
So for anyone who is currently holding MSTR, timing seems crucial. We know January 15th is the big day. Is there any advantage to waiting until the last minute?
None at all. In fact, it's the opposite. Risk management is all about timing here. You have to make a decision about your MSTR position before January 15th. The analysis is very clear on this. As you get closer to these big binary events, uncertainty just explodes, and so does volatility.
So if I wait until January 14th, I'm basically just gambling. I'm subjecting myself to these wild price swings based on last-minute rumors and announcements.
You're turning an investment into a coin flip. The prudent strategy for almost any investor is to reduce your exposure or get out completely well before that decision is announced. Avoiding the uncertainty of a potential 40% forced sell-off is much more important than trying to squeeze out a few more percentage points of gain.
Let's talk about a dangerous temptation. A trap, maybe? Buying the dip? If this fear builds and the stock starts to fall hard before January, MSTR might start trading at an NAV discount.
Meaning the stock is trading for less than the Bitcoin it holds is worth.
Exactly. And normally, a discount like that is a huge buy signal.
Normally, yes. But we have to put up a giant warning sign here. For MSTR, in this specific situation, trying to buy that discount is like trying to catch a falling knife. It is incredibly dangerous.
Why is this discount different? Why is the knife so sharp here?
Because the discount itself is what could destroy the value. The price drop, the discount, is the very thing that could trigger their debt covenants. It could cause a margin call.
Which would force them to sell Bitcoin.
And the second they sell Bitcoin, the underlying NAV, the very thing you thought you were getting a discount on, plummets.
So an investor thinks they're smart. They buy MSTR at a 10% discount to its Bitcoin value. But the fact that the price got that low is what forces MSTR to sell Bitcoin, which then causes the NAV to drop by 20% right after they buy.
You've got it. You haven't bought a discount. You've bought a ticket on the Titanic after it hit the iceberg. For anyone but the most sophisticated professionals, this is a dip that must be avoided.
Okay, so last question. For those very sophisticated, aggressive investors who still think Bitcoin is going to rise but see the flaws in MSTR, what's this long-short play the analysis mentions?
This is a very targeted surgical strategy. It's designed to profit specifically from MSTR's problems while still capturing the upside of crypto. It's simple in concept. You buy or go long Bitcoin, probably through an ETF, and at the same time, you short MSTR stock.
And what's the goal of doing both at once?
The goal is to isolate MSTR's unique risks. You think Bitcoin is going up, so your ETF position makes money. But you also believe MSTR stock is going to fall even faster or further than Bitcoin because of the MSCI exclusion, the debt, all of it. This play lets you profit from Bitcoin's rise while also profiting from MSTR's decline. It's a bet that MSTR is structurally toxic, even if its main asset is not. So to just wrap up this whole deep dive, the story of MSTR right now is really a battle between two huge opposing forces. On one side, you have the diamond hands ideology tied to that psychological tripwire at the $75,000 average cost.
And on the other side, you have the cold, hard math of Wall Street.
Yeah.
The non-negotiable reality of a $9 billion passive fund exodus that's locked in for January 15th.
MSTR's story has pivoted. It's no longer about aggressive growth, it's about mandatory survival. So for investors, the focus has to shift too. It's not about seeking profit from leverage anymore, it's about minimizing the severe self-inflicted structural risk.
And with safer, simpler options like spot ETFs out there, The whole reason for owning MSTR has pretty much disappeared, replaced by this very clear and very present danger.
Which leaves every investor with that final provocative question to think about over the next 6 months. Is MSTR's future going to be decided by the passion and excitement of the crypto market, or by the cold, hard, unbreakable rules of institutional index funds?
The structural risks are just too high to ignore. Don't forget to subscribe and hit that like button.